Hello guys and welcome back to That Investing channel. So in the UK we cannot invest in SCHD and that bugs a lot of people, me included. I want to get that 3.42% dividend yield per year with massive dividend growth sitting around that 11% over the past 5 years. It's the perfect dividend growth ETF and everyone across the pond raves about it and includes it in their portfolios. So where does that really leave us? Well, it means that we have to look for alternatives. And in this video, I'll be showing you the best equivalent ETFs in the UK, according to me, and what you might expect from them. I've trawled through tons of exchange-traded funds that are available in the UK, and I think I've found some that live up to the high standard we might expect from SCHD, so we can collect that passive income and grow those dividends each year. And at the very end, I'll maybe include a way to also accomplish what SCHD does from the UK with no fees attached that I'm currently doing. So if that interests you and you want to see similar content to this in the future, then feel free to hit the like button and smash that subscribe button too. As always, this is not financial advice and meant for educational purposes only. So what is the fund we're trying to match? SCHD is the Schwab US Dividend ETF that is very popular and has done impressively over the past 5 years or so. Let's make a checklist so we don't miss anything and compare it to our other contenders. It doesn't have the tech-heavy focus that the S&P 500 has. This appeals to many people who don't want those big growth stocks. They just want to grow passive income through dividends. In fact, SCHD only has just over 12.5% technology stocks and is fairly balanced across sectors. We have a little over 17% in industrials, 16.7% financials, and nearly 16% in healthcare, making up the heavier weightings. It's focused on the benchmark index of the Dow Jones US Dividend 100 and has companies like Chevron, Lockheed Martin and PepsiCo making up larger parts of the index, to name a few, which in total adds up to around 104 stocks across the ETF itself. Now we need to talk about fees as well, because it weighs in on what we'll be looking for in our other ETFs on that hunt. SCHD currently holds an expense ratio sitting around 0.06%, which is actually extremely low, all things considered. Then we have the overall returns, because the investment goes up and down like the market. So we need to look at how much SCHD has returned over the past 10 years or so to give us an aim for the other stocks we're looking at. SCHD with dividends reinvested has achieved an 11.33% annualised return over the past 10 years, so that's a high mark to beat, but I'll be noting it down for future reference. Finally, we need to talk about dividend yield, because we want to know how much £1,000 in SCHD will make us, mainly because it's really nice to know how much you're making passively, right? So it's currently sits around 3.41% for SCHD, which means that if we invested £1,000 in this one, if we actually could, then that would return £34.10 over the space of a year in just dividends. And as we mentioned earlier, it has a dividend growth rate over the past 10 years, which is huge, sitting around 10 to 11% annualised again. So in summary, we're looking for a UK ETF that invests in a fairly balanced range of stocks that's not heavily weighted towards technology stocks like the market is. It has to have those low fees sitting around or close to that 0.06% expense ratio that is taken to maintain the fund itself from your investment. Has to have a largely good overall return. If those dividends are reinvested, that could try to measure up to an impressive 10 to 11% over the past 10 years. And finally, it has to have a yield close to 3.42% and a dividend growth rate, most importantly, sitting close to that 10% mark. Wow, okay, so this could be more of a challenge than I actually first thought. Now, firstly, we can't consider ETFs that we can only invest in America, right? So taking out the obvious, like SCHD itself, VIG, VYM, the investors from America might compare to this one too. We're left with not that many that are UK regulated ETFs that offer a growing dividend. So we're looking for ETFs that have that UCITS regulation standing for a very long and boring name of Undertaking for Collective Investments in Transferable Securities. Just a fancy way of saying regulated in the UK, if you ask me. My first contender for the crown of SCHD is FUSI.L, which is the Fidelity US Quality Income ETF. Now this one has only been open since 2017, so we don't have masses of data to work with, but we do have, it's pretty promising if you ask me. It's worth noting though that this doesn't focus on the Dow Jones Index, so we can't get a tick for that one, but instead focuses on the Fidelity Quality Income Index. We have an overall return from dividends reinvested over the 5 years of 13.69% per year, which is great, and we can see it actually outperforms SCHD and outperforms the fund itself it's trying to replicate. Obviously it pays the dividends in pounds, so it might be this has something to do with this, and we can see by the graph if we invested £1,000 8 years ago when the fund started, we'll be sitting on £2,379 with those dividends reinvested. So we get a tick in past performance, in my opinion, although it would be nice to have more data to work with over a 20-year or longer period. But yeah, we've got to do what we can. Then we move over to expenses, and unfortunately the charges are 0.25%. So for every £1,000 we invest, they charge us £25, which is a lot higher than the charges for SCHD of around £6 at 0.06% charges. So unfortunately we don't get a tick for that one either. Yield sits at 2.02%, which is quite a bit lower than that 3.42% yield. So again, no tick. But we can say the overall returns are more impressive over a shorter period, so actually it might not matter. Anyway, then we get on to the composition. 97.77% stocks held in the US with a 100 holding, which is similar to the SCHD, but unfortunately with a focus on tech and the information sectors. So around 30% of the fund, followed by 13% in financials and healthcare at 12.35%. So no tick because it's heavy in tech. Just out of interest, we can see its top holdings take up quite a percentage as well, with Microsoft taking up 7%, Apple 5.5%, Nvidia 5.2%, etc. So quality dividend growth stocks though, leading to a higher dividend growth that I couldn't really find anywhere. So that's really annoying, I could tell you, but just from looking at their holdings, I can estimate we can comfortably put that dividend growth in the 10% slot. So I'll give it a tick for that one. So 2 ticks overall performance and dividend growth, but doesn't, however, match SCHD in index or holdings, expenses or charges. And they are a lot higher in charges as well. And the yield is lower than we were looking for, but not a bad start to begin with. 2 ticks. Next up, we have HDLG, or Investico S&P 500 High Dividend Low Volatility UCITS ETF. God, that was a mouthful. Made back in 2015, so a little bit more data. Overall return is 125% since 2015, so over 9 years or so, making its annualised return overall with dividends reinvested of 13.8%. So very good, and that's got us our first tick. Again, I'd like more data, but a lot of these ones seem to be newer than SCHD, so I've got to make do. So moving along, the charges again a lot higher this time at 0.3% rather than that 0.06% we look for. So that could actually really start to mount up, and unfortunately that gives us no tick. Dividend yield though looks a lot more impressive at 3.88%, so that's a big fat tick on the yield, higher than SCHD so doing well so far. Holdings are 95% held in the US and have a heavier weighting towards utilities at 17%, real estate 16.9%, and consumer staples at 13.23%. Okay, so missing a lot of that tech with an only weighted average of tech stocks at 2.79%. Again, another tick. We are looking for a fund that, just like SCHD, isn't necessarily weighted towards those big technology stocks. However, it's worth noting only has around 50 holdings, so half SCHD's amount of 104. Now, I think you guys will be disappointed in me, but again, I can't find a dividend growth rate. But judging by their top 10 stocks and weight towards yield, I'd say the growth rate may fall below that 10% we're looking for. So, no tick for that part. All told though, more ticks this time around at 3 ticks achieving that dividend yield, overall return and holdings. And, of course, the weighting as well. We're maybe looking for more, but missing out on charges or expenses ratio and that dividend growth. But we're actually getting there. Now for our final competitor. It's worth noting though, there was a lot of competitors like GGRG and DHS, etc. I just couldn't cover them all, and after looking through loads, there is plenty of chance I may have missed some. So feel free to let me know in the comments, as I'm sure I have missed some. But the final one I selected to try and match SCHD in the UK is VHYL. Now this stands for the Vanguard FTSE All World High Dividend Yield UCITS ETF, and it's been going since 2013, so the longest stretch we have to examine from our contenders. Overall return over the past 10 years sits at 127%, with those dividends reinvested, so 12.7% annual return, giving us our first tick. Moving along to charges, we can see it sits again quite high at 0.29%, not meeting the desired low charges of SCHD around that 0.06%, so no tick again. Dividend yield sits at 3.08%, which is pretty good, over that 3% mark, so I'll give it a tick even though it doesn't necessarily beat SCHD, it's not that far off. Now this fund is made up of 1,855 holdings, 41% in the US, and the rest spread out across the world. So a high amount more stocks than SCHD. However, if we look at sectors, financials make up the biggest weighting at 26%, followed by consumer staples at 10.48% and healthcare at 10.3%. So with technology's weighting sitting around a fair 8.81%, we actually get another tick here for not weighing towards those tech stocks. This one's biggest holdings are actually Broadcom, JP Morgan Chase, and ExxonMobil. So we're staying away from those big tech boys. Now in terms of dividend growth, this one I believe sits around or just below that 10%, around the 6 to 7% mark. So we can't actually tick that one. So to sum them all up, we actually get a tie between the contenders, between HDLG, the Invesco S&P 500 High Dividend Low Volatility UCITS ETF, and I said it again, and the VHYL, the Vanguard FTSE All World High Dividend Yield UCTIS ETF. With 3 ticks a share, it's worth noting they both fell on the expenses ratio, which all came in high across the contenders, and every other fund I actually looked at was pretty damn high. None of them really came close to the low expenses of SCHD, and I think this could really eat into your returns over the long term if you're talking about decades, so it's actually a bit of a shame. And then there's that dividend growth rate. Now I can't confess this one was really hard to predict. With so many stocks involved and only limited data, some inferences sort of had to be made by me. I've tried to be as fair as I can and give you guys the best choices, but like I said, I'm only human and may have missed them. None of these funds hold the exact same stocks and weighting of SCHD, and what I'm currently doing on Trading 212 is actually create a dividend growth portfolio that I hope will provide steady income and good returns, similarly to SCHD, but maybe try and beat the market while I'm doing so. Now, it might be possible to forego the expense charges of these funds, which ones that they offer, and try to recreate SCHD with individual holdings. But this is only on brokers that don't charge per buy, as I know some do and Trading 212 doesn't. And it carries a lot of inherent risk as well. But it's an idea, and I like to pick holdings I think have better futures than maybe other ones held in these funds with more weighting towards them than I would like. But that's just me, and like I said before, I'm not an advisor, so don't listen to the weird guy on the internet. But best of luck with your investing, guys, and see you in the next one.